video for making your budgeted income statement and budgeted balance sheet. So with the Starbucks example, I have the cash and capital budgets completed. Okay, so we started with long-term debt. Eventually, we had excess cash, so we were able to make payments on the debt. We're finishing with less than what we started with our long-term debt. With the cash budget, I decided to pay off the account payable in October, and we finished with our minimum cash balance. So now we need to make the income statement, budgeted income statement, and this is for 3 months. Okay, so first thing is your revenue. So that's sales. How much sales do we have for this 3-month period? And you can get this from, I guess, your stock tracking table where you originally created the sales forecast, or you can get it from anywhere that you have your sales for the 3 months inserted. So I'm going to take it from the page where I have all of the the basic information to make your budget. So I'm going to add October, November, and December. This is my 3 months of sales. And just let me get my spacebar working here. That's 3 months of sales. Cost of goods sold, there's a few ways you can get this number as well. So we can either take this revenue number, so the 3 months, and multiply it by our cost of sales percentage, which is back in your sheet with your percentages and your budget information. So that would give us the cost of sales. A second way you can do this is go to your Schedule C, which is where you calculated your inventory purchases if you had to make it. So in this schedule, we have cost of goods sold for the 3 months. Okay, so we add these three together, we get the same total, 1492.53. So whatever way you want to calculate it, it's fine, you'll get the same number. And then we go revenue minus cost of sales. That's our gross profit. So that's step one in making your income statement. Step two is just taking the expenses that you've already calculated from your different schedules. So variable expenses comes from Schedule D, which is your cash expenditures budget. So variable, this is the total for the 3 months. Fixed expenses, Schedule D, 4998. And then we have depreciation expense, 34433. Now we also have uncollectible account expense, and this is coming from Schedule B, where 5% of our sales are not collectible. So that's going to be a debit journal entry to uncollectible account expense and a credit to account receivable. So we're basically writing off the account. So this total here gets transferred to your income statement. Okay, so again, that came from Schedule B, uncollectible account expense on your income statement. So at that stage, let's add these 4 expenses. So I'm going to do a sum function, add my 4 expenses together. We have total operating expenses. So now we can calculate operating income, gross profit minus total operating expenses. And now we deal with the interest. And also at this stage, you could call this the EBIT number, so earnings before interest and taxes. So now we're going to subtract our interest expense and add our interest revenue. So interest expense, this is coming from your cash and capital budget. Okay, annual interest expense. We're going to add these 3 totals. This is the interest that you paid. And we have interest revenue also coming from the cash and capital budget. That's up here in cash budget. Interest revenue, we have 3 months. 1, 2, 3. So from here, we go operating income minus interest expense plus interest revenue. Here's our earnings before taxes. And so income tax expense, if we come back to our budget information, income tax rate 19.52. So here's our income tax percentage. So we have to calculate income tax expense. It's going to be 155.1. So these are the earnings. How much taxes do we pay? We multiply it by the percentage, so 19.52. So we get $30.27 in income tax expense. So net income would be earnings minus the income tax expense, 124.83. So that's your income statement. And now we can move to the balance sheet. And the best way to start your balance sheet, guys, is to go back to your original balance sheet. Okay, so we're looking at screenshots of the balance sheet. I had you guys transfer this to Excel. Now you're going to use this balance sheet. So what I'm going to do is just copy these two columns, copy, and I'm going to paste this on this page. I'm now going to make the budgeted balance sheet. Okay, so this is now for December 31st, 2021. So here's my 3-month budgeted balance sheet. But we have to make changes. So I have what's being changed and what's not being changed for the Starbucks example. Okay, so cash, for example, is going to change, right? This number is not what we began with. And this is coming from the cash and capital budget, right? Here's what we started with. We spent cash, we made cash, and we finish with 268.66. So in the balance sheet, this is the first number that's going to change. So I'm going to delete that number, go equal sign, come to my cash budget, click on my ending number in December. This is now my new total. And what you'll notice is that total assets now changes, okay? And it doesn't balance total liabilities and shareholders deficit, okay? Now it should once we're done making all the changes. So this is the first item here that definitely will change for everybody. Second asset, short-term investments. No change here, okay? I didn't do anything with this account. I didn't add to it, I didn't subtract from it, so there's no change. Accounts receivable, yes, this does change. So we'll highlight this one. It's no longer 879.2, okay? So in Schedule B, we collected that amount, right? The 879.2. which we see right here. We collected the amount and we wrote off 5%. We now have a new account receivable total. So that's right here on the Schedule B. So we have accounts that are waiting to be collected from October, November, December. So we're going to link this number to our balance sheet. So we delete that 879 and we're now going to link the 1421. So that changed. Inventory also changed, okay? So we're going to delete this number. That's coming from Schedule C. Here we see in our inventory, we used inventory, we made a purchase here, we made a purchase in December. Our ending inventory is 305.88. Okay, that's desired ending, that's what we finish with. So I'm linking that to Schedule C. Prepaid expenses, nothing changed here, okay? Again, I didn't add to this, I didn't subtract it anywhere in the budget, so that remains. So here's total current assets. We move down to long-term assets. There's not going to be much change with this section for anybody, okay? Unless you bought some new long-term assets, which some of you may have. Then you would have to insert that here in this section of your balance sheet. But the only item here that's going to change with the Starbucks example is property, plant, equipment, okay? So it's 6431.7. Now I didn't sell or I didn't buy any more equipment, but what I did do is record depreciation. Okay, we had 3 months of depreciation expense. So what we now have to record is accumulated depreciation, which will be a subtraction. So I'm going to go subtract, and you can get this from either Schedule D, depreciation expense, 123. So I'm going to subtract that number here. So notice that it goes down. And you can also go to the beginning sheet here, depreciation Here's 1 month. You can multiply it by 3. That's your accumulated number. And that's the only item that changes for long-term assets. So now we see the sum of our current and long-term assets is 15,775.72, which does not equal what we have here in total liabilities and shareholders' deficit. So as you're making changes, what you guys can also do is just show the difference, because you want these two to equal. And right now we're off because we haven't made any changes to the second half of the balance sheet yet. But as we make the change, this should get closer and closer to 0. So accounts payable, this changes. So I'll highlight this. It's not going to be 1889. Okay, we've actually paid this completely. If we look at Schedule C, we have 15294. This is a purchase that we pay for in October. Okay, so this is part of the account payable. And when I look on the cash and capital budget, we also, in October, paid the remaining account payable. So these two numbers together, the 15294 and the 1036.76, that's the 1189.7. That's the original account payable. So that's completely paid, so I delete it. But what does exist is from Schedule C. We made a purchase in December of inventory. When do we pay for it? January. That makes this an account payable. So here's my new account payable, much less. Accrued liabilities didn't change. Payroll and benefits didn't change. Income taxes payable. This does change. So some balance sheets, you may have this item. If you don't, you have to add this in. For Starbucks, they have an amount for income tax payable, 1291.7. And we just recorded income tax expense on the income statement. So we now have to add this 30.27 to this total. So this now goes up by the calculated income tax expense. Because to get this number here, this would actually be a journal entry for income tax expense debit, and the credit would be income tax payable. Okay? So this is the journal entry that would create these two numbers as a debit and credit. So we see the income tax expense here on the income statement. This income tax payable gets added right here on the balance sheet. Store value card liability, no change, so that stays. So now we get new total current assets. Notice that the difference between the two sections of our balance sheet is getting lower now, getting closer. This should eventually be 0. Long-term debt, this is definitely going to change because in the cash and capital budget, we started with that number, 11,167, and we made payments. What we finished with, 8488.7. Okay, so this is now our new long-term debt. Deferred revenue, other long-term liabilities, that does not change. Okay, so total liabilities still the same. Or sorry, change to a new total. And then we come down to equity, no change with common stock, no change with paid capital. Retained earnings changes. Okay, so retained earnings, it's a negative here for Starbucks. So I'm going to keep this amount. And because I just recorded net income, this is part of your retained earnings calculation, 124.83. So I'm adding this. It's going to decrease this loss here. It's actually retained loss. No change with OCI, other comprehensive income or loss. And no change here with non-controlling interest. And so what we're left with is the same total assets, total liabilities, and shareholders deficit. Okay, so balance sheet balances. And we can compare this now to the original and see how some of the accounts change and some of them did not. You only change the accounts that you change in your budget, okay? So if you compare from side to side, which is a good idea, you guys should, when making your balance sheets, always, keep the original that you're starting with, we see that some of the accounts are changing here. So cash changes because we use it. Short-term investments did not, so you keep it. You're only making changes to these accounts that change, and you link it back to your schedules. Okay, nothing should be typed in. You should have the numbers linked. But these are the original numbers. Okay, so I see that this is what was on the original balance sheet. It stays. Okay. And so after this 3 months, our assets now go down, and the liabilities and equity also goes down after this 3-month budget period. And that is the process that you would want to go through to make your income statement and balance sheet. So everything's connected with this budget, okay? Now the next step in this assignment is to do a increase and decrease. And I'll just see what the percentages are for the increase and decrease. I think it may have been 10%, but let's just do a 10%. So when you're making the changes to the forecast, what you want to do, guys, is copy your original forecast and paste it as a number here, okay? Or you could type it in, but just keep your original data, because now what we're going to do is we're going to change our forecast by 10%. So I'm going to multiply October, November, December by 1.1. So I'm now increasing my forecast by 10%. And what you're looking for now, guys, is how did this change my cash and capital budget? But before you get to that stage, what you'll want to do, guys, is go to Schedule C and just make sure that these amounts do add up, okay? And right away we see that total needed for November. Okay, we have 895.1, and beginning inventory was 750.97, which means we need to make a purchase. So you will have to make an adjustment, or you may have to make an adjustment in your Schedule C. So the purchase here is going to be 144, which means beginning inventory here is going to be the 305. Okay, so we have some small changes taking place. We now have purchase taking place here. And when we go to cash and capital budget, we can see that that insert, or that change of inventory payments is now here in December. And what you'll want to do now, guys, is either copy this cash and capital budget, because this is now the cash and capital budget with your change of 10%. So you have an increase in 10%. So you can copy this, go to a new sheet. And what I'm going to do is paste the numbers. So I don't want any of this to be linked. But this would be, you can call it 10% increase. And we can change this to dollars. So now it, matches what you had. And then you come back to your income statement and we do the opposite. So now we're going to do a 10% decrease. I'm going to go 0.9, multiply my sales forecast again by 0.9. And then again by 0.9. Come to Schedule C. Notice now that we don't need to buy inventory, okay? So this is now going to be deleted, right? We have beginning in November is greater than total needed because we have less sales, so we don't have to buy as much inventory. So now our beginning in December is going to be the beginning minus cost of goods sold. And we have a smaller purchase now in December, okay? Come to cash and capital budget. We don't have this purchase showing up now, and we're going to take this copy and let's just put it next to the 10% increase. So now this is our 10% decrease. And so what we notice here is that with the decrease, our loan is now larger. We have less cash. We weren't able to pay off as much of the loan. We see with the 10% increase, it's 8514.87. So we had more cash to pay off more debt. We also noticed this inventory had to be purchased, okay? With the 10% increase, we ended up having to pay for inventory because we ran out of the beginning, that large amount of beginning inventory got used up. So in December, we had to make another purchase. But what you want to do here, guys, is have both sheets. You can put them on separate sheets, but you want to talk about these small differences. And this is going to be different for everybody as well, because you all have different sales forecasts. This is just the Starbucks example, but you guys are going to have most likely something completely different than me, okay? But when you are making these percent changes, just remember to go to your Schedule C and make sure you're fixing, if you need to, this part of your schedule. And then to finish, we're going to go back to normal, okay? So bring the numbers back to what they normally were. So I'm just deleting these three amounts. And, just to make sure I didn't screw anything up, here's the data, again, which I just pasted to show that these were the amounts I started with. And your cash and capital budget goes back to normal. And we have 10%. This is 10% increase and decrease, so we can just call it 10% change. And you would want to briefly describe what the changes are when your sales forecast went higher, when they went lower. What does this mean for your available cash and for your capital budget? So I'll post this sheet for you guys to have kind of as a template. But what you guys definitely should not do is submit this exact file and try to insert your own data in there. Because at this stage, guys, in the term assignment, you should have your own Excel sheets, right? Part 2 is done. You're now just trying to finish this budgeted income statement and balance sheet. And these sheets, guys, are going to be completely different for everybody because you all have different balance sheets than Starbucks. So none of your balance sheets are going to look like this example. You're going to have different accounts for sure. So again, when you're submitting part 3, I shouldn't see any of these Starbucks accounts in your assignment. That just means you didn't do it based on your own sheet. You just took this template and tried to insert your own data in there. Don't do that, guys. You have to try to do this from scratch on your own, using your own balance sheet. So hopefully this tutorial video helps with the process and you guys can get your assets and liabilities to balance. And I will post this sheet now and stop the video here.